Hello, greetings. Welcome to Dividend Blasters. This is our 99th video, and our focus today is Gpiq Soars with the bulls. Qqqi shields you from the bears. That's right. I'm giving it away. I'm going to tell you that's what I'm going to talk about. Gpiq is better when you are in a bull market. Qqqi is better when you are in a bear market. I'm going to talk a little bit about why that is. I'm going to show you the data. But first, a disclaimer. What I say is not financial advice. This video is for information and education. It reflects my own personal opinions, research, and experience as an independent investor for more than 30 years. So do your own research, do your own due diligence before making any major financial investment decisions. I'm going to show you these two bad boys side by side. This chart I've showed you before in the last couple of videos. I updated it a little bit, but basically same metrics if you've seen the other videos. QQQI is managed by Neos. It's trading at about 52 and 3/4. GPIQ managed by Goldman Sachs, $50.68. These are as of last Friday, August 29th. These both launched within a few months of each other. GPIQ in October of 2023, QQQI January 2024. They both replicate the NASDAQ 100 and sell covered calls against their holdings in NASDAQ 100. So that's really where the similarities begin to end. They are both actively managed ETFs, but the options strategy, there's always the options strategy with where the differences come in when you're comparing covered call ETFs. QQQI has a higher distribution yield. And why do they do that? They're generating more premiums every month. How are they able to do that? They are putting forth more of their holdings in options trades, and they are setting their strike prices in a very aggressive fashion. They tend to set these at the money or in the money, and so they're going to generate higher premiums. When you do that, there is a greater probability of their options being assigned and their shares being called away and sold. What happens when you do that? When you do that, those shares are gone. But if you're in a bull market, you've already missed the upside. When you do an options trade, when you sell a covered call option, you are basically capping your upside. There's a real probability, if you're in a bull market, of those shares being called away, and the upside will be missed. The difference with GPIQ is they have a lower yield because they are putting less of their holdings into their options. So instead of putting 50 to 100% of their holdings and selling a covered call option, they will vary that depending on the market conditions between 25 and 75%. I would imagine that in this very bullish market, they're closer to 25%. And they are setting their strikes further out of the money. So when you do that, you're going to generate less premiums monthly. The fund will generate less premiums. They'll collect less premiums. And there is a reduced risk of the option being assigned and the shares being sold. And when that happens, you are availing yourself to a greater upside potential. And in a bull market, that's really, really important. Now, let me just flip that before I go on. In a bear market, the QQQI strategy is really better suited to cushion you against downside corrections. Whereas the GPIQ strategy, you're going to feel it because GPIQ's total return is more dependent on price return, whereas QQQI's total return is more dependent on generating premiums. Very different. One is income focus, one is price appreciation or growth focus. And I have that down at the bottom. And at the very bottom, basically optimal conditions, GPIQ, better for bull market, QQQI, better for bear market. Both of these pay monthly distributions. NAV erosion or NAV decay, not a real issue with these either of these ETFs. There's always a little bit of NAV erosion or NAV decay, but these guys they manage it well. So it really comes down to the market conditions as well as their approach. Assets under management. Let me just go back up. QQQI is about 3.5 times the size, about 4.25 billion, whereas GPIQ 1.4 billion. The expense ratio is about a little more than double for QQQI. So 68 basis points or $68 a year for every 10,000 you invest. For GPIQ, 29 basis points or $29 a year. I already mentioned the distribution yield. It's about 4 points more for QQQI. And that's because they're putting more of their holdings up and they're setting a more aggressive strike price. So 13.9 versus 9.91. Next three rows, basically I'm comparing price and total return for three different time frames: year to date, 1 year, and inception to date. And what you see basically here is that you're going to get more price appreciation with GPIQ because less of their options are being assigned. They're capping less of their holdings upside, whereas QQQI is just generating higher premiums. They're getting that cash in every month. Both are sound approaches, but one approach is better in a bear market. One is better in a bull market. You can see the NAV returns; they're very close, and I've covered this in the previous videos. It's not something I want to focus on here, and I already covered the bottom. Let's move on. So I already said it. GPIQ better for bullish trends. QQQI better for bearish trends. All right. I've hit that point pretty hard. And I feel like I've covered this, but basically GPIQ, they got their dynamic covered call strategies. They vary what they're putting up in covered call option trades anywhere between 25 and 75%. The more bullish the market is, they're going to have fewer trades. If it begins to come down or flatten, they'll generate more. So anyway, that means that uh, uh, there's going to be more of their holdings not capped, which is good in a bull market. And I already mentioned the out of the money strike price approach. All right. QQQIs is kind of the inverse. They perform better in a bear market. The strategy, their options overlay strategy, is designed to maximize income. Here at QQQI versus GPIQ, it's designed to maximize growth. And, it's better suited for bearish trends. It's all about increasing monthly premiums and income and getting that cash coming in to cushion your negative returns or your market corrections. The options pricing strategy goes hand in glove with that. It's an aggressive one. Uh, those strike prices are set at the money or in the money. They're more aggressive, more risky on options being assigned, but you're going to generate higher premiums. Let's take a look at the data. So here, basically, I'm looking at, and really, first thing, before I look at bear market trends and bull market trends, I'm just going to draw that distinction a little bit more clearly here between price return and total return. So, and I'm setting the time frame 3 years because this is basically when both of these ETFs started. So, if you look at basically the price return, GPIQ is killing QQQI. QQQI doesn't care about that. They care less about price return. They care more about generating premiums and also protecting against bearish trends. Whereas GPIQ is more focused on growth and bullish trends. And so that's why they are doing less of an options overlay. So that's price return for a 3-year time frame. Let's look at total return. Total return, 3-year time frame. GPIQ is basically crushing QQQI. And why is that? It's basically because of the market conditions. Yes, they have a lower expense ratio, but uh, they have less of their holdings capped. And we are in a very bull market. We've had pockets of bearish trends and corrections the last few years, but basically we've been in a bull market. And so you basically see that the total return here, which is price appreciation plus distributions, GPIQ is at 57.61%, QQQI 32.78%. Now, let me say this. Let's say the market takes a major uh, crater. It craters 50% over the next 2 or 3 months, and it's continuous. You're going to see a total return flip. You'll see QQQI defend better and cushion against more of those um, losses and market corrections better than GPIQ, because GPIQ is more sensitive and more reliant on price growth and price appreciation, whereas QQQI is less reliant on that. So that's an important distinction to make. I wanted to get that out to you before I move on. So, all right, if I want to look at bearish trends and bullish trends, I would say that January through March of 2025 was more of a bearish trend. The NASDAQ 100 was down about 8%. The S&P 500 was down about 4 to 3%. High level messaging here is that QQQI dampened its declines because they were generating greater distributions through the covered calls. They had a better total return than many of the competitors, and I believe including GPIQ. GPIQ also dampened their declines, but again, their options overlay strategy is going to generate less uh, premiums. So the return was a little bit more negative than QQQI's because they rely more on price performance. Let's dial in a little bit closer to the data. So NASDAQ 100 again was down about 8%. GPIQ price return, I'm just looking at price return for GPIQ, down 8.89%. QQQI was down 9.28%. So, QQQI actually did a little bit worse here with price return. Let's actually take a look at total return. And I put the green check here because both were negative, but this was a little bit less negative. Um, Looking at the total return here, GPIQ down 6.46%, QQQI down 6.03%. So QQQI did a little better job of dampening those downturns with the options overlay. They were both negative. You can't correct for everything, but it cushioned it a little bit better. And I'm just going to go back a little bit. So price return was less negative for GPIQ than QQQI, um, but overall the total return in the bear market goes to QQQI. All right, now bull market, and I would argue that we're in a bull market. We're in the end of August here, and I would say that since April through last Friday, we're in a bull market. NASDAQ 100 has returned to about 20.5%. S&P 500 14.68%. QQQI's return is positive, but it's lower than GPIQ's. The covered call strategy works better in bearish trends naturally, but it caps the upside in bullish trends. GPIQ's return is higher. The capital growth and appreciation strategy that worked against them in the bearish trends allows an outpacing of QQQI in the current bullish trend. Let's look at the data. So I already mentioned that the NASDAQ 100 up about 20.47%. GPIQ's price return, it's about 3 points higher than QQQI's, 13.81% versus 10.48%. It kind of really sets itself up and above, essentially, QQQI. Now, that's the price return. Let's look at the total return. It's very close. It's very close. 17.86% to GPIQ, 17.36% to QQQI. So QQQI is making up a bunch of it through the superior premiums that they're generating. All right, we saw that here, but you know, the total return is still going to go to GPIQ because the price return in this bullish market is better. So, how do you interpret these? You got two contrasting approaches, and they really underscore this importance. This is a major takeaway. You really need to match your strategy of what you invest in based on what's going on in the market. If that's important to you, some folks they just want to generate income, and that's fine. And if that's the case, investing QQQI all the time, or if you just want growth, invest in GPIQ all the time. But there's a way to calibrate this to try to get the best of bull market trends and bear market trends. So let me just say this. So basically, QQQI, they've got an adaptive approach around their options overlay strategy for higher income. So they have a fuller options overlay and a more aggressive strike price setting approach, and it's helped it outperform GPIQ in the bear market from January to March. In the bull market, it's really GPIQ. They've surged ahead because they're getting more of that upside. So what am I doing? Like I said at the beginning, I invest in both. Right now, we're in a bull market, and I'm allocated more heavily into GPIQ. I'm right around 80%. If I took my investment in both of these funds, I would say about 80% of those funds are GPIQ and about 20% are in QQQI. Nobody knows when a bear market's going to start and a bull market is going to end, or vice versa. We just don't know. We do our best to manage, and we basically are trying to spread our risks. So I like to, I'm a dividend investor, but I'm also looking for unique upside potential because I believe we are in an inflection point in the market with artificial intelligence and a lot of great companies driving innovation and a lot of money pouring into the market. That the bull market is something to not ignore. And there's wealth making opportunities here. So I'm watching those. I like to get those distributions, but I do not want to sacrifice upside. I am watching that very, very closely. So I invest in both. And so that's the major takeaway. Look at the macroeconomic conditions, look at the market conditions, and invest appropriately. That's what I do. Before I close, I would just say that as an affiliate partner of Seeking Alpha, I can offer you introductory discounts to the premium subscription to Alpha Picks, as well as a bundle, which is a little bit of both. You can see the link, you can see the QR code. And I'll say that for premium, you get a 7-day free trial and you'll get $30 off the normal price. Alpha Picks, $50 off the normal price. I'll tell you what, I love the insightful analysis I get from premium for Alpha Picks, and I subscribe to both of these. I love to get those 2 stock picks every month, which kill the S&P 500. If you want to get them both, get the bundle. All right. And here's a little bit more information. You can read this at your leisure. A little bit more in-depth description of each subscription. The QR codes are below. The links are below. If you're interested in getting access to really insightful dividend investment content, check me out on X, on Instagram, as well as on Facebook. And I really hope you subscribe to this channel and give us a like and hit that notification bell so you will know the next time a video comes out. Have a wonderful day, and until our next video, God bless.